What is up, Eagle investors? I hope everyone's having a great week so far. It's been a rocky road, not only for stocks, but as well as crypto. In this week's episode of Eagle Investors Market Recap, I'll be covering what we've been seeing in the markets, as well as going over what we are seeing in the crypto markets, its impact on specific asset classes, going over the FOMC minutes that were released on Wednesday, and also the potential for Fed tapering and what it means for specific asset classes in your portfolios as well. So first, starting off, seeing the performance for the Russell 2000 versus the S&P 500. The Russell 2000 covers how small caps are performing. S&P 500 is a good gauge for how large caps overall are performing. So we're seeing the S&P 500 outperform for the week today. I'm filming this Thursday morning, approximately 40 basis points or 0.4%. For the month, we're seeing the Russell 2000 underperform by almost 0.65%. And then on the 3-month time frame, we're seeing the S&P 500 outperform the Russell 2000 by over 8%. And something that I'll keep my eye on is how we're going to see rates moving forward in yields. If we see yields continue to go up, that's good for the Russell 2000 as key industries such as financials and as well as specific insurance companies tend to do well when yields go up. While for the S&P 500, you could see some of these growth names get hit as a result of rising yields. This summer in particular, many people are worried about transitory inflation, and we've already seen the impact within the CPI numbers that were released last week, that we saw rising commodity prices. In particular, we saw rising energy prices as well as rising prices within real estate, along with real assets such as looking into lumber as it plays into real estate, as well as even rental and used cars have seen a dramatic increase in prices as there have been many supply constraints and the demand for many of these vehicles continues to stay strong. So that's something I'm definitely going to be looking into. The Federal Reserve is looking into it very closely as well and seeing whether they'll start tapering some of their purchases. Tapering means that they're reducing their purchases on things like U.S. Treasuries as well as mortgage-backed securities and more. So that's something to keep an eye out on as well. So going into the 10-year yield, we're seeing the 10-year yield trade almost range bound for the past few weeks. It's trading at that 1.63 range. This is very good for the markets as inflation worries did continue to creep up, but now we're seeing with rates staying around the same price, this is good for growth and tech in particular, helping see a larger rebound. Then it wouldn't we wouldn't see tech performing the same manner if we did see yields continue to rise. And this is also good for specific commodities as well. So going into gold, with yields not going up significantly, that means the US dollar is not performing as well. So we're seeing gold, the US dollar and gold are inversely related. So we're seeing gold start to rebound. Gold was able to cross that 1800 range, and it's continuing to rebound as well. It's been seeing a new cycle. Before we going back to the 6-month range, we did see a lot of selling since January going into April, and now we're seeing that rebound. I personally think that we might see a larger traction towards gold. Over this past week, we did see selling in the crypto space. We saw Elon come out saying that Tesla no longer accepts Bitcoin, as well as specific institutional players taking their money out of crypto. And there have been reports that some major institutions are putting their money back into gold. So that's part of the reason why we're seeing gold continue to prop back up. Now, in terms of the U.S. initial jobless claims numbers that came out this morning, we saw the U.S. jobless claims drop by 34,000, which is showing that the market is continuing to recover. We're seeing a lot of support from the reopenings through the coronavirus vaccine rollout, as well as the continued uptick in demand through stimulus policy within the Federal Reserve, as well as the government overall as well. With both that fiscal and monetary support, I think that this recovery will continue, along with the fact that we're heading towards the summer months. So we can see larger spending within specific discretionary spending spaces such as travel, leisure. One other thing that I'm looking into is crude oil prices as well. I think crude oil prices might see a recovery. Over the past week or so, we did see the crude oil prices come back down just due to the coronavirus situation within Asia, specifically India. There are concerns about lower demand. So we did see some of those prices come back down. And it's something that I'll continue to watch. I personally think that we might see crude oil rise into the summer, especially if we see that increase in demand, and supplies haven't increased significantly still. So I think that there could be a potential rebound in crude oil. I'm still watching for a potential entry for energy ETFs such as XLE. I personally think that if there's the buying opportunity for XLE might be around that $49 price range. Now, going into the Federal Reserve minutes that were released on Wednesday, I wanted to talk about why the markets didn't react too unfavorably towards the Federal Reserve talking about looking into potential tapering. Right now, the market is predicting tapering to talks to go through within like the November-December timeframe. They believe the economy will recover by then. But over the summer, I think that these talks are going to be more significant, as we might see that headwind inflation, partly due to supply chain constraints. And on the other side, I believe we'll see an increase in demand as well. So that's something to look into. The markets are actually up today, Thursday, at the time of recording. And I believe that's just because the markets are very worried about inflationary pressures. And if we see Fed tapering, that might reduce some of these inflation worries, as well as we might see a slower economy, which helps reduce the inflationary pressures that we see as well. Now, in terms of the Federal Reserve balance sheet, we haven't started tapering, so we're still seeing those asset purchases come through. One thing that I've read is the fact that one of the first purchases that the FOMC is expected to start tapering is mortgage-backed securities, just because of how strong the housing market has been and its contribution towards inflation as well. So we could see tapering within mortgage-backed securities start within that November-December timeframe. And what that means for the markets themselves is we could see the housing market cool down as a result, because we might see a rise in some of these mortgage rates. So that's something I'm keeping in mind. It's more of a long-term picture to look into, not necessarily a short-term play, but something to definitely keep an eye out on. Back when we saw indications of a hawkish Fed back in the 2018-2019 timeframe, we did see the market start to panic after seeing that rise in interest rates. So I'm going to be looking into whether we see something like that be replicated if we see more hawkish Fed than we expect. But as of now, there aren't too many expectations that we'll see the Fed make any moves within the next few months. Keeping an eye out on if we see moves that will be made towards the November-December timeframe to help curb inflation. So that's something to definitely keep your eyes on. What if the Fed starts to taper? What does that mean? It means that we could potentially see value outperform growth. Growth typically suffers when interest rates go up, as well as real estate. Real estate doesn't do as well if interest rates go up. So those are two industries that could do worse. And then industries that might be able to take advantage of a rise in interest rates would be insurance companies as well as financials in particular. So financials might outperform, and as well as specific energy companies. So those are some names to see that might have an impact. Again, thank you all for listening. If you're not already part of the Discord server, make sure to join with the link below. We tried to post as many videos as possible, so make sure to hit the like button and subscribe if you haven't already. And if you have any ideas for any future video ideas, leave them in the comments below. Thank you so much for listening, and have a great trading week.